All right, welcome back to The Explainer. Today, in Lesson 7 of our testing series, we're focusing on something literally game-changing, turning your losing trades into winning ones by tracking institutional footprints. We're going to map out exactly how to read the market when things just don't go according to the basic plan.
So what actually happens when your absolutely perfect order block just fails? Look, we've literally all been there, right? You do your homework, you map your structure, and you find that absolutely picture-perfect smart money zone. You set your trade, and then, bam, price blasts right through it, leaving you stopped out and, frankly, completely confused.
But here's the real paradigm shift you need to grasp. A broken zone is not a dead zone. When that level breaks, it actually leaves behind a highly visible footprint by the big players. Today, we're going to prove that even when a smart money level fails, there's a purely mechanical way to exploit that exact failure for profit.
Okay, so here's our game plan for today. We'll quickly cover when perfect blocks fail, the advanced block rules, mitigation versus breaker blocks, wicks and reclaimed zones, and finally, wrap up with why higher time frame context matters.
All right, let's dive straight into part 1, when perfect blocks fail and the very real pain of broken zones.
You know, the truth is, the market often just totally ignores those fresh, standard order blocks. But those exact failed zones, they actually offer incredibly reliable entries. Why? Well, because banks and massive institutions don't just disappear when a zone breaks. Their actions there give us the exact clues we need to anticipate their next massive moves.
Moving right along to Section 2, the Advanced Block Rules, where we'll get into mean thresholds and SMC unicorns.
Okay, so enter the concept of the mean threshold, or the MT. Basically, it's the exact 50% midpoint level of a single candle. Understanding this rule of halves is absolutely crucial here. If a candle body closes above this 50% line, the block is failing. But if the price comes down and actively rejects that midpoint, that means smart money is actively defending the zone.
And this brings us to the core criteria for advanced order blocks. You find your mean threshold, and a clean rejection of that midpoint confirms your entry. But wait, it gets better. If you find an advanced block that perfectly overlaps with a fair value gap, you get what we call an SMC unicorn setup, a massive, ultra-high probability overlap. Though, keep in mind, even without the FVG, a single candle can still act as a block if that 50% threshold is genuinely respected.
Let's hit Section 3, Mitigation versus Breaker Blocks, also known as the liquidity hunt.
Let's compare these two directly, because they look similar but act very differently. The mitigation block happens in an uptrend when price basically fails to break the previous high, a swing failure, and then tanks, breaking the previous order block. Institutions are just using this return to clear trapped positions at break-even. The breaker block, however, it's far more aggressive. It actively sweeps the previous high first, grabbing that buy-side liquidity and completely clearing out retail stop losses right before it crashes.
Now, there is exactly one massive difference between these two types of blocks. Just one singular, critical distinction that completely changes how we trade them. Can you guess what it is? It's liquidity.
And because of that massive liquidity grab, breakers are fundamentally higher probability setups. Seeing a high get actively hunted, immediately followed by a sharp, aggressive downward displacement, that creates an incredibly powerful entry. The market has already grabbed all the fuel it needs from retail traders, making the resulting move way more reliable.
Okay, on to Section 4, wicks and reclaimed zones, where we uncover hidden entries and market ladders. So here we're looking at the rejection block. Instead of just staring at candle bodies, we're actually hunting in the long wicks at the top or bottom of a major swing. Turns out smart money actually sneaks their massive orders inside these wicks. Apply that mean threshold rule to the wick itself. If price rejects that exact 50% midpoint of the wick, you've got a precise entry with a tiny stop loss. But if the body closes past it, you know it's a trap. And this dynamic creates what we call the reclaimed ladder. Think of it like a staircase. Step 1. As price moves to a higher time frame target, institutions build their own private blocks. Step 2. Price hits that target and turns. Step 3. Price actively reclaims those exact old blocks on the way down. It's honestly kind of structural poetry. The market uses the exact same steps to support price on the way down as it did building them on the way up.
Finally, Section 5. Higher time frame context matters, and why we must follow the institutional footprints. Before we get to the real secret sauce, let's just lock in this mental framework. Advanced blocks optionally use a fair value gap. Mitigation blocks, they don't hunt liquidity, but breaker blocks absolutely do. Like, that's their whole defining trait. And rejection blocks are all about utilizing those long wicks. Keeping this taxonomy in mind is going to help you rapidly categorize these footprints in real time.
But hey, you really need to heed this critical warning. You can't just go trading every single breaker you see. Context is absolutely everything here. Aligning these blocks with a higher timeframe objective, like a massive daily or 4-hour zone, is basically non-negotiable. When you wait for price to grab liquidity at these massive levels first, you completely stop guessing at random shapes and start genuinely following the institutional footprints.
So, what are your next steps for mastering all this? Well, first, jump straight into our app and download the advanced block sheet to lock in today's mechanical rules. Second, make sure you're subscribed so you don't miss out. And third, get ready for Lesson 8, where we're going to dive deep into the 3-candle swing formation to show you how to mechanically protect your stop losses.
I'll leave you with this final thought to chew on. Are you actually trading alongside the banks, or are you just providing their liquidity? Every single time a standard block fails, that question is being answered on the chart. Master these advanced footprints, stop being the liquidity, and start turning those inevitable failures into real profit. Thanks for hanging out with me on this explainer, and definitely keep studying those charts.